Hi, we're going to walk through problem 8-6A, disposal of plant assets. Onslow Company purchased a used machine for $178,000 cash on January 2nd. On January 3rd, Onslow paid $28.40 to wire electricity to the machine and an additional $11.60 to secure it in place. The machine will be used for 6 years and have a $14,000 salvage value. Straight line depreciation is used. On December 31st, at the end of its 5th year in operations, it is disposed of. So first, we're going to record the journal entries to record the machine's purchase and the cost to ready it for use. Cash is paid for all costs incurred. So on January 2nd, we're going to record the purchase of the machinery, debit machinery, $178,000, and credit cash. Now the next two expenditures that we incurred are to place the asset into service. So those are also going to be capitalized. They're going to be added to the cost of the machinery. So we have debit machinery, $28.40, and credit cash for the electricity. And then also on the 3rd, we're going to debit machinery for $11.60 and credit cash to secure it into place. So at this point, our asset has a total cost of $182,000. We can get that from just adding these three together. Next, we're going to prepare the journal entries to record depreciation of the machinery. So if we take the $182,000 again, that's going to be adding the 3 debits to machinery. We subtract the salvage value of $16,000 and divide it by the useful life. So the annual depreciation is going to be $28,000. So at the end of the first year, we're going to record depreciation. We're going to debit depreciation expense, $28,000, and we're going to credit accumulated depreciation, $28,000. We are going to do this every year. So the problem asks us for the first year and the 5th year, but we would actually be making this entry every year. So at the end of 5 years, we would have $140,000 in accumulated depreciation. That would be the $28,000 times 5 years. So next, we're going to be looking at and calculating the journal entries for the machine's disposal. So the problem told us that it is disposed at the end of 5 years. We calculate accumulated depreciation. $28,000 times 5 is $140,000. If we want to calculate the book value of the asset, the original purchase plus costs incurred to place it into service was $182,000. We subtract accumulated depreciation, so we get a book value of $42,000. Next, we have 3 different scenarios. These are all independent on different disposal amounts. So the first one is if we sold the asset for $15,000 cash. So we're going to debit cash for $15,000. We would be bringing in $15,000. We're also going to write off the asset. So we're going to be crediting machinery for $182,000, and to write off its accumulated depreciation, we're going to be debiting accumulated depreciation for $140,000 that's been recorded so far to date. So we're going to be making this part of the journal entry on every scenario, writing off the asset and accumulated depreciation. Then we're going to compare the book value, $42,000, which is the difference here, to the cash that we are receiving. In this example, we are receiving less cash than the book value. So we are going to incur a loss equal to the difference. So we're going to debit loss on sale of machinery for $27,000. The next example is if we sold it for $50,000. So we're going to debit cash for $50,000, and we're going to write off the asset and its accumulated depreciation. In this example, we're receiving more cash, $50,000, than the book value. So we're going to have a gain of $8,000. So losses are going to be debits, their expenses, and gains are going to be credits, their revenue. You can also use the amount of the journal entry that you've already recorded to determine if you need an additional debit or credit to make sure it balances. And the last scenario, if the asset is destroyed in a fire and we collect $30,000 cash. This is very similar to these. We're just going to be recording it with a little bit different detail in the account title. So we receive the cash. We're going to write off the asset and its accumulated depreciation, just like we did in the other scenarios. And we're going to have a loss because the cash received is less than the book value. So the only difference is, instead of loss on sale of machinery, it's just going to be called loss from fire. Again, this is going to be $12,000. It's the difference between the book value of $42,000 and the cash being received for $30,000.